Good morning, expats. Thank you for tuning in for another episode of Expat Mortgages. My name is Jeremy Harper. Today in the hot seat, we have James Ridley back on the desk, and we have a big episode to unpack today.
We certainly do, mates. We're coming to you a few days after the federal budget was announced, the 2026-2027 Australian federal budget. And there was a lot to unpack in there. I think today we'll mainly focus on a lot of the tax reform as it impacts a lot of our listeners, a lot of our clients, unpack it a little bit. And I think it's really important we give everyone a bit of an understanding of what the next steps are as part of these proposals.
Yep, definitely. Should we start with that as a headline to lead out
Yeah.
with?
Yeah, absolutely. Proposals. So everything that was announced on Tuesday night was just a proposal. They have obviously put dates in there, but it has not been legislated. Right now, I'm having a lot of conversations with clients because there's a misunderstanding that it's been legislated, and as soon as they announce it at budget night, it's done and dusted, and it's locked in. That is not the case. Typically, when we hear from the budget night and the proposals and we review the budget papers, they are just proposals, not legislation. So therefore, we can't act just yet until we start to see the draft legislation come out and make informed decisions. If we were acting and making changes and decisions right now, we are just jumping at shadows because it is not legislative yet. Now, if we go back and have a look at past budgets when they have announced these kind of proposals and what the lead-in is to actually receive the draft legislation, typically, the government will release draft legislation, the first sort of tranche from usually mid-May all the way through to the end of June. That's sort of the first draft run. And a lot of the time that'll be the heavy things like the tax reform, because that's what probably will be a priority for them to run through Parliament. We usually see a second tranche of legislation that pops out in July through to September, which usually covers off. When we talk about and have a think about the process of getting this legislation or what they've proposed through and all the way and receiving royal assent and enacted and having applied, it's really important we talk about probably the nuances and everything that they've got to run through, because I feel like that's probably not that's usually not understood. So let's have a look at it. So firstly, when they announce new policy, they have to draft the legislation. It receives consultation for a couple of weeks once they release the draft legislation. So that's for key firm stakeholders to provide commentary on it, provide submissions to see if there needs to be any
Yep.
tweaks.
Yep. Can I jump in there on
Yes,
that?
go.
Because
Yeah,
also people can make submissions themselves. There'll generally be an email and you can put feedback. So even if you're a small tax firm out there that hasn't been asked to submit, typically like your chartered accountants, your CPAs will be asked to make a submission with this type
mhm,
of changes, but you're more than welcome as well.
absolutely. Really good examples. Main residence exemption, when that was introduced to remove for Australian expats, as well as changes to the foreign resident capital gains tax, as well as tax residency as well. We all provided consultation reports on that to the
Yep.
Parliament. Now with this one, it is obviously quite significant, the level of tax reform. So when it goes through this 2 to 4 weeks of consultation, this is typically where we see some material changes take place on what they've proposed. So tweaking tax rates, tweaking dates in which it might apply, tweaking tax vehicles. That's usually where the heavy changes will be applied. Once it's gone through that period of consultation, it then moves into the final bill being developed. So Treasury usually incorporates the feedback and then they draft the final bill and then it enters Parliament. Now, it goes through several stages. It goes through the first reading, which is the formal introduction into the House of Representatives, and then it goes into the second reading, which is the policy debate. That's when the Senate, the Greens, the Independents, they all get to have their own debate on the different types of parts of the legislation. It goes into a committee stage and then it goes through a third reading. Once it goes through a third reading and it's voted on by the House of Reps and it doesn't receive any pushback, it then moves and enters the Senate for scrutiny. If it moves through the Senate, because the Labor has the numbers with the Greens or the Independents, then it moves through to royal assent. Usually when it enters the Senate, that's when the blowouts can happen in terms of the turnaround timeframes. If it gets through the Senate relatively cleanly, it receives royal assent and then it will apply. probably good to talk about an example of
Yep.
legislation, which was, I suppose, recently put through. Um, Division 296. So Division 296 is this tax that was announced a number of years ago for superannuation accounts and self-managed super funds where they wanted to tax unrealized earnings if your balance was over 3 million. Now,
Yes.
a really good example of a timeline of a type of tax reform, a massive tax reform, was this piece of legislation was first announced pre-budget on the 28th of February, 2023. We
23.
then,
Yep.
we received the proposal as part of the 2023 federal budget. And then when we look at the timeline of events for that kind of proposed legislation, the first draft of the legislation was done in October. It had a consultation window of 3rd of October to the 18th of October 2023. It then went into Parliament from 2024 to mid-2025. The bill then lapsed in July 2025 because the proposed dates had elapsed within the legislation. So then it went back and obviously it was redesigned, policy was reset. Government obviously announced major redesign of how they were going to tax. They introduced the second tier of 10 million, the extra 10% on that on
Yep.
very large balances. A second draft was then put to Parliament in December 2025. They opened consultation for a number of weeks up until mid-January 2026. A new bill was then drafted and entered Parliament, the House of Representatives, in February 2026. And then it moved through the House of Representatives, it moved through the Senate, and then it received royal assent in March 2026, and it applies as of 1 July 2026. So that's a really good example of when they announce these kind of proposals. It can take a few years to get through, and it does go through a period of consultation, sometimes redesign. Um, After that consultation period, that's typically where the heavy changes are made. So
Yep.
industry bodies such as CPA, chartered accountants, I'm sure they'll be providing plenty of consultation on this tax reform because of how punitive the changes are, especially around CDT, around the concessions we previously were meant to have, trust distributions as well. There's a lot to unpack.
Yep. And so question on that example we just used there for Division 296
Yes.
from announcing at the start of this bill or what the policy they wanted up until what we've actually got through and we've now got it signed off. Was there a material change, do you think, between the start and the finish?
Oh, absolutely. Massive
Yeah.
one.
Yeah.
And I mean, remember, they wanted to tax unrealized gains and earnings within self-managed super funds. Now they are only taxing under ordinary concepts, which just means you are only paying that extra rate of tax on income or capital gains that you realize. So
Yeah.
yeah, confirming it did go through a material change, which is often what we see.
Material change. Yep. Now, I think we should keep that in the back of our mind with what we're going to discuss today. I mean, it's the same government, but the material difference between back in 23 and now is Labor has a lot more control in the lower and the upper.
Correct. Yeah, they do.
So there is, I guess, a higher risk that this could go through with not a lot of tweaks or in its current state.
Yeah, I think the hurdle will probably be the Greens.
Yeah.
Greens probably want it to be maybe more punitive to like that's probably what we've seen
I want
with
to go harder. Yeah.
that's probably what we saw with the Division 296 tax. They wanted the balance to be 2 million and no indexation applying. So we'll see what happens through there. Obviously, a lot of voters are pissed off. I haven't spoken to any clients that have said anything positive about the
Mm.
tax reform. And I feel like our clients are typical Australians living and working overseas, and then they come back and this is sort of going to hit them, especially around changes in negative gearing, CGT concessions, trust distributions, all those sort of things. So
Yeah.
it's going to, and it's sort of, that I won't go too heavy into it today because we'll unpack it a bit, but there's just so much that we could talk about here.
Yeah, yeah. So why don't we get into, I guess, one of the key changes? We are talking mortgages and property, so negative gearing. Do we
Yep.
want to sort of unpack, number one, let's just kind of high level the concept of negative gearing. Do you want to go through that?
Yeah, absolutely. Let's look at it from an Australian resident lens and then an expat
Yep.
lens as well.
Yes, and
So
an expat.
yep. So let's start with the Australian resident. Obviously, if I'm negative gearing a property, it means my income or my tax deductions on my property are more than the rental income. So when that happens, the property is negatively geared. It's technically running at an on-paper tax loss. That loss then goes against my wage income in my tax return and reduces my overall taxable income. And when that happens, I typically get a tax refund. And the reason for that is my marginal tax rates have been paid on my behalf through the tax system by my employer at
Yep.
my wage income level. But when I do my taxable income, this negative gearing, this loss on the property has reduced my taxable income, and that taxable income is less. That's negative gearing in a really clean nutshell.
Yep.
And when we compare that to an expat typically doesn't have any wage income in Australia. They don't have anyone putting any tax away into the system or an employer paying tax on their behalf because they're not living or working here. So typically for an Australian expat, negative gearing doesn't really exist. However, they get to accumulate the income losses each year, which roll over and carry forward into future years. And then if they're
Hmm.
overseas for a number of years, once the property moves into being positively geared based on the rental income being more than the tax deductions, then those losses are slowly wound down once more. So negative gearing is a funny concept for Australian expat because they don't get the year-to-year benefits. They just accumulate the loss and then it winds down the loss as their income grows. Whereas negative gearing for a normal Australian resident living and working here in Australia, they get the benefit immediately every financial year.
That's right. That's right. And just on that, when you look at the numbers, yes, the benefit, or if you want to call it benefit, or the loss of negative gearing, the loss on residential properties that we normally talk about in this policy setting,
Mhm.
the biggest driver, the biggest cost or the deduction you're claiming on your property is interest. What's
Yes.
happened in the last couple of years? Rates have jumped up, right? Which is driven by inflation. RBA puts up rates. Inflation is driven by government. So through the government spending and policy settings, they've created inflation in the system, which has increased rates. So when everyone was paying 2-3% on their investment mortgages, the negative gearing conversation is very, very different to 6.5% interest rate. So I think in the short term, the government will frame this as everyone's taking advantage of this, but realistically, one of the drivers in generating this loss is actually high interest rates, which is driven by the government. And
Absolutely.
it's maybe a little bit of a feedback loop because even the Treasury papers said that this will increase rents.
Yeah, their modeling was, I think what they say is like $2 a week
$2 a
on the
week,
average.
half a coffee a week. No, a third of a coffee a week.
Oh, mate, what coffee are you drinking? But yeah, that's exactly right. Unfortunately, often they do get it wrong with those papers and the financial year economic sort of forecast and the flow and impact. I think they said it in terms of what it's going to do to the property market initially, what a 2% change in
Hmm.
sort of growth.
Yep.
Um, it might drop property growth to by 2%. Again, don't know the modeling on that because they often get that one wrong as well. But it is going to have a dramatic impact. And I guess they've shifted negative gearing to now just new builds, off the plan builds. So, anything that you're buying off the plan or a property that's adding to the housing supply, you can still negatively gear against your wage income and you can
Yep.
still negatively gear existing property that you already owned before budget night, 7:30 p.m., 12th of May. Anything that you purchase after that, if it's already a pre-existing or existing property, you don't get the negative gearing benefits to go against your wage income. You can accumulate the income losses or use it to
Yes.
offset sort of rental income. But typically what you'll see is anyone buying an investment property, say now that's existing, the losses will just accumulate on their tax return. And then
Yep.
over time, as the property becomes positively geared, it'll then wind down the losses. Or if you sell the property, I have seen that some of the commentary is that you can use the losses to offset some of the capital gain that would be taxable. But we still need to see the draft
Still needs
legislation
a
on that.
detail. Yep.
That's
Yep.
exactly right. Yeah.
Yeah, I think that's a key takeaway. You don't, it's not like you lose that loss. It's still on your tax return and it's
No.
still captured. So
Yep.
that's a key takeaway. Something else that's being clarified is if you were to do some sort of debt recycling, they're being very explicit in claiming interest for share investing is still allowable regardless of the date. So
Yep.
they're purely looking at property. I mean, on the new builds, I don't want to go down a bit of a rabbit hole because I think we could, but this is one of my things where people may start to pile into new builds, investors. I'd just be really careful, particularly around that sort of sub-mil apartment market. I don't think
Mm,
that's going to be rosy for a lot of investors if you start to pile into it, because if you think about the resale value, it's a bit like a electric vehicle. You
mm,
get all the tax benefits on some of those some of those sort of salary sacrifice. But what is that car's resale value in 4 or 5 years' time? What would a brand new apartment's resale value be in 5 years' time when you go to sell
mm.
and it's no longer now a new property? Who can you sell that to?
Yep.
Uh, it's not going to be on occupiers or families. It's not going to be
No, and
investors.
I think it's that market that you said, sort of that 1 mil range, up to 1 mil, maybe a little bit over. I think the apartment market, where if you're buying a really boutique high-end luxury
Yeah,
apartment, millions of
downsize the
dollars
market.
worth,
Yeah.
I think that will probably soldier on a little bit depending on the location. But yeah, I think we'll see probably a lot of property spruiking firms popping up here where they'll come across as like a buyer's agent, but they're just flogging off the plan crap. We've
Yep.
seen it time and time again because they get paid big commissions in the background from the big developers.
Yep.
So it means we could have more, I suppose, sharks in the property market preying on the young, preying on first home buyers, all those sort of things, which is a little bit nerve-wracking.
Yes.
But as we said before, it's all proposed. We need to see the
Yes.
draft legislation. We need to unpack that and see the long-term impacts on any strategy or wealth strategy that you're definitely running. Why don't we change gears? Let's talk about CGT, the big one.
The big one. Okay. So the big one. Where do we start here? So they're going back in time. We're
Yep,
going back to 1999. Isn't
we
that a
are
song? I think that's a song. I think it was a pop
going
star
back in
song
time.
back in time. So we've gone from a simple system. The Ralph Review said, let's go to 50% discount,
Yep.
simplicity, ease. Let's get the transactions going. And now we're going back to a system that's probably going to get accountants super excited. I mean,
We're going
one
back to
thing
the
that's come
future.
out of this budget is make sure you've got a good accountant. Make sure they're on your Christmas
Uh,
card list. Like
oh
they
God.
are worth their weight in gold.
Yeah, that and property property valuers. Um but yeah, let's unpack the change. So the indexation model, so the ATO will continue publishing indexation factors for rolling quarters now. They'll have to. They used to. I'm not sure if they still do because the indexation model's been gone for a while. Like you can use it depending on when the property was purchased, but everyone sort of defers to the discount method because it's more lucrative.
Yep.
Now, from 1 July 2027, the proposed legislation wants us using the indexation method on pretty much any property. You can opt to use the 50% if you already owned it. So there's grandfathering, but any gains from 1 July 2027, you'll use the indexation method plus the minimum tax rate of 30% on those gains as well. So that's an important one. Any gains that accumulate after 1 July 2027, the flat tax rate, minimum 30% will be paid on those gains. Gains that have accumulated up until 1 July 2027, you can use the discount, the 50% discount concession if you own the property before budget night. And then whatever that discounted gain is, that goes on your tax return as taxable income. So that'll be taxed at your marginal tax rates. And then any gain that accrues from 1 July 2027, you'll use the cost-based method for indexation, and then you'll pay a 30% tax rate on that as a minimum. So Jeremy is spot on in terms of you need a good accountant to work through this in the future. Not only that, you'll also need a good property valuer
Yep.
because all properties are essentially going to need to be valued as of 1 July 2027. So you know the different periods of growth. So you're segregating the period of using the discount concession to the next period of using the indexation method.
Yes. Yes, that's correct. Okay. So who does this impact? Well, should we talk about expats to start off with? And
Yep.
where do they sit currently with the CGT
Yeah,
concessions?
good question. So unfortunately, Australian expats, they don't actually get any concessions around capital gains tax on property transactions if they own them in their own name. So they can't access the 50% CGT discount. That was removed back on the 8th of May, budget night, 2012. So any capital gains that accumulate from that date, 2012 up until, say, now, you're essentially paying tax on 100% of the capital gains if you've owned that asset that entire time as a non-resident of Australia. So
Mm.
nothing is really changing for Australian expats on property if they already own investment properties back in Australia, because you can't tap into the concession. One thing which wasn't clear in the budget papers
Yep.
is if with this future indexation method, is that going to be a sweeping change and knock out the old rules, which could mean Australian expats might be able to use this indexation method, which would be actually a win for Aussies living overseas. Now, I'm reading in between the lines here, and that's why we need to see the draft legislation. But there actually could be a little win here for Australian expats living overseas from 1 July if you could tap into the indexation method. So we will definitely have to keep a very close eye on that one, because that would
Yep.
be a huge win for Australian expats or foreign residents, non-residents of Australia. The other concession that wasn't mentioned in the budget at all, which Aussie expats can't tap into, is that main residence exemption. If selling the
Yep.
property asset as a non-resident, can't use the MRE.
Yep. So just a question on that calculation. So we've adjusted the cost base of our asset. We've disposed of it under these new rules. We've worked out our real gain on that. Now, just mechanically, is that just going to be on your tax return minimum tax rate on the net capital gains? Is that the marginal rates? So would that
So
just essentially, when you get to, this is probably getting in the weeds, but when you get to that front section of the tax calculation on your ITR,
yeah,
essentially there's going to be a brand new line item to say
have to be.
like a top up tax,
Yeah,
like a
yeah.
levy.
I think they'll have to be. Again, accounting software is all going to change around how they're going to calculate this. Accountants' work papers will have to change. I think a lot of software companies are seeing this as probably an opportunity, a little add-on package. Um, Fed 2026, 2027 CGT calculator. Yeah, I think the design of tax returns will change a little bit, because
Yeah,
also, like, when we think about negative gearing, there needs to now be a separate section for like this bucket of accumulating income losses, negative gearing on
on established properties. Yeah,
unestablished properties purchase from now on. That doesn't exist right now. That's technically accumulating losses. There is a carry forward losses that already exist on our tax returns, but this is actually going to be a separate line item because it
separate line
can't be
item.
used. So yeah.
Interesting, interesting. And I guess for that 30%, essentially all in to get, because this is talking about Australian tax residents, but with the marginal rates, once you hit $200,000 taxable income, that's when you have an effective tax rate of 30%.
Yeah, exactly right. Average tax rate is
So I'm just,
30%.
say your income's $100,000 from salary, how would that work in terms of you've had $100,000 capital gain, so now we're at $200,000 total. I'm so intrigued how that 30% works in that scenario.
Yeah, I mean, beats me at the moment. So, because you're paying a lot more in tax, like, and what will be just really interesting is how they're going to pro rata. Like, you'll have your taxable capital gain before 30th of June 2027,
Yep.
and then that's going to be taxed at your marginal tax rates, and then any capital gain after that will be taxed at a minimum tax rate of 30%, but it's also taxable income. So how's that going to get squashed together with your marginal tax rates as well? Like, it's obviously means that you're going to pay more tax on the discounted gain as well, because your taxable income's getting pushed up, but then you're paying this 30% minimum tax rate as well. It's the mechanics of it are still an unknown feature
Mm,
of the proposal. And that's why we need to be patient. We need
yep.
to wait for the draft legislation. And then I have no doubt we'll be unpacking it once more.
And in the current state, I've spoken to a lot of younger Australians, tax residents who are, a lot of people are trying to not keep their money in cash and save a deposit for property. They are building a share portfolio and hoping that will grow. outgrow inflation, and then they can use that for deposit later, and that's going to impact them. Particularly, a lot of people get into like ETFs where within the ETFs they're selling, so they're realizing capital gains events more frequently, right? Because they're rebalancing. So those
Yeah.
capital gains events will
No.
flow through to your tax return, and
Yeah, there's like strong arguments that people will lean heavier into like share portfolios or ETFs. Obviously, expats can benefit from that right now because they're not taxable here in Australia. They're not defined as taxable Australian property, but out of the budget, negative gearing still applies to share portfolios. So you can still claim the interest deduction on, say, an equity loan that you're using for a share portfolio.
yeah,
The CGT changes will definitely apply to shares, but I mean, people might opt to use shares a bit more now just because you've got a lot more flexibility on how much you're selling down at a time. You can dial in the CGT or the capital gains that you're realizing. Whereas, for property, it's one chunky asset. If you're selling it, you're
yeah,
selling it. There's no
yeah,
flexibility there. So that's sort of a cause and effect that we might see people using shares more strategically as part of their broader wealth strategy rather than just maybe all in on property. But again, still need to unpack that draft legislation still.
yep, yep. Okay. And should we talk about the trusts?
Yes, well, I mean, Labor's removed the effectiveness of using a discretionary trust, haven't they? So
They've really given a big shout out to discretionary trusts. If you look at the detail, they've given carve outs to fixed, to farmers, to
super,
testamentary,
super, yep,
super.
yep,
It's
yep.
really just the family
Discretionary
trust.
trust. It's exactly right. So most family trusts can live for 80 years, give or
Yeah.
take, depending on the state in which it's set up on, or set up in, sorry. Um, but essentially they've recommended a 30% minimum tax on distributions from trusts. And when that tax is paid, it will be treated as a non-refundable tax credit. So it means that any income that goes into a trust from dividends, a business, anything, in order to get it out of the trust, it will pay a minimum of 30% tax, or it'll pay essentially a 30% tax, and then it'll go down to the individual beneficiaries with that tax credit. They'll report that in their Australian individual tax return. And then if the income is, say, $70,000, well, the average tax rate on $70,000 is a lot less than 30%. As Jeremy just said, 30% is the effective tax rate of someone earning 200,000.
Mm.
You'll have the tax credit, but it's non-refundable. So it means you won't have to pay any extra tax, but you are not entitled to a tax refund. And that is what is so damaging. A lot of people strategically set up discretionary trusts. They'll distribute income to different family members or tax vehicles to reduce the overall tax that they have to pay to the ATO. But this effectively removes the tax efficiency of using a discretionary trust. It might mean people might opt to use maybe companies instead. But it is very punitive, and it's certainly going to have a lot of accountants, advisors scratching their head. And this one, I think, will hit home for a lot of Australians, because a lot of Australians use family trusts for investments, businesses, and therefore we'll have to wait and see what the draft legislation looks like on this. But this is probably one of the more punitive ones.
Yep. Yeah, correct. The double taxation in the corporate beneficiary.
Oh,
Um,
nasty.
I just think there's a lack of, I don't think people in Treasury understand how these trusts operate and why they're in place. I think
Yep.
it's framed as this 1% that utilize this structure, but realistically, there's lots of mum and dad businesses that are operating in a trust.
Yep, absolutely. I mean, uh, I think they're trying to obviously capture that very large cohort of trustees that distribute income to, say, adult children, retired parents on low taxable incomes, to obviously reduce their overall taxes. But this is going to hit business owners. This is going to
Yeah.
hit, obviously, a lot of retirees, which might not have much in super, but they have a lot in family trusts. So it's so punitive. There is rollover relief for anyone that has used a trust or has uses a trust structure for their sort of business structure. So they're going to provide some rollover relief from 1 July 2027. And it'll be 3 years from that date. And then the 30% minimum tax will apply from 1 July 2028. So there is a difference in the dates there. So very concerning. Obviously, a planning window can start now, but again, we need to see the draft legislation and see the kind of momentum it starts to build in the Parliament. Once we
Yep.
see that, we can start making informed decisions and tweaks.
Yes. Yes. Correct. Correct. So a little bit of a recap, a couple of
Yep.
action items for
Yep.
our expat audience. The first one was don't panic.
Yeah. Don't panic. Don't do anything just yet. Don't make any changes.
Don't make any changes. Have a read of Division 296 if you want some bedtime reading, or just have a look at the
Yep.
summary of how long
Yep.
that took.
Yep.
And I guess if you compare that to these proposed changes, these are in its current form, you know, huge changes for the overall
Oh,
tax system.
they are. And I think another good example is like the main residence exemption, which was abolished for expats. That took 4 years.
Four
So
years.
2017, 2018, 2019, and finally 2020. Um, so keep an eye on it. We'll be keeping a very close eye on it. I think as soon as the draft legislation is released, there'll be a lot that will be getting published. We'll be unpacking it for Aussie expats, Australian residents as well. And we'll see what kind of feedback is given through that period of consultation, because often what we have heard in the proposal often gets changed, tweaked, restructured, redesigned.
Yep.
And that is the most common likely outcome. It'll get redesigned, ideally less punitive. I just can't see how this is really going to help the property market with the negative gearing and the CGT. Just doesn't make too much sense. Labor has really run through their wish list, which we knew they would.
Mm.
And we'll see the following impacts in the coming weeks and months.
Yep. And the final thing on the checklist is maybe not straight away, but get in contact with your accountant. So just start to think about how is this going to impact yourself? What are the options available to yourself personally? What are your goals in the next 5, 10 years? And how you're going to achieve those goals? Because, there's still many, many pathways to accumulating and growing your wealth. As much
Oh,
as this
absolutely.
feels like roadblocks, there's
Yep.
ways through this.
Yep.
So it's about thinking about what options are available to you and how do they align with your personal goals.
Yeah, absolutely. Yeah, I mean, if all these are legislated as is, it really actually supports the fact that superannuation is such a powerful concessionally taxed retirement vehicle. No changes were made to super. Maximum tax rate of 15%. Long-term capital gains, 10%. When we're in account-based pension mode, all tax-free.
Mm.
So it just goes to show that now is the time to start paying attention to super and building up that asset, because that is still now the most tax-effective investment vehicle, retirement vehicle asset that you can build. Um, I think there'll be some pivots in strategies where if it gets legislated, I think shares will be used a little bit more commonly rather than just all in on property, negative gearing shares to a degree as well.
Hmm.
Looking forward to seeing the outcomes through the draft legislation and then tweaking strategies if needed.
Yep. Yep.
Yep.
Well said.
Great. Great. All right, guys, well, stay tuned. Look out for our socials, couple of webinars and seminars coming up as well in a city, country near you. And in the meantime, stay tuned for what's next as part of the budget proposals.
Yes. Thanks, James. Thanks, guys, for your time.
Thanks, guys.